Hi, these are just short notes that I've added to augment to go with the lecture and the book, and covers some of the parts that we haven't done. When we're looking at firms, our initial thought might be that firms are trying to maximize profits. But this rests on an assumption that the people who manage the firm and the owners are the same set of people, and also that the aims of the owners is to maximize profits, whereas we know in sometimes what's called lifestyle companies, that firms, the people in the firms, just want to have not an easy time, but they want to balance life and work. They just happen to be in business and they're making a choice. But the first assumption is always profit maximizing. For those who have done microeconomics before, the level of price, the level of output that's chosen to maximize profit is where the marginal revenue is equal to the marginal cost. If you haven't done microeconomics before, don't worry about that. The next line says really what you need to know, that total profit is the difference between total revenue, what you receive from selling your goods, minus the total costs of producing those goods. And when that gap between TR and TC is the greatest, you're maximizing profits. However, in many firms, there's a separation of ownership and control. So the ownership we might regard as that we call principal, and they employ people to work on their behalf. Thus we use the language agent. Thus we talk about the principal agent problem. Okay, and for the rest of this very short talk, I'm just going to talk about some of the ways we can look at that. One of the ways when we're talking about the separation of ownership and control is that if the control of the firm is in the hands of the managers, they might have things they're trying to achieve, their motives, which are different from shareholders. They might be going for prestige. They might think that if the sales are high, they catch the eye of other firms in their sector and they're more likely to get a better job, or they might get bigger income. Okay, so managers' salaries are often related to the sales of their division rather than the profit, because the profit is harder to calculate than the sales. Okay, now if you're maximizing sales, that means that if, again, for those who've done microeconomics, the marginal revenue will be zero. And always, and I'll show in a diagram in just a second on these slides, which I've taken directly from the website that accompanies Griffiths and Wool, the profit maximizing output will be above the profit maximizing output. So if we go from the left, from 0 onwards, we go to the profit maximizing output and beyond. So we're not doing the best in terms of profit maximizing that we could for the firm. Okay, on to the next slide now. Alright, this is a diagram that might seem a bit complicated, but the total revenue curve is shown in blue and the total cost curve is shown in black. The line that's marked TP is total profits. So you can see at some point to the left and the right of the two break-even points, total profit is negative, but it reaches its maximum at the output QP. But as I hope you're noting that if you look at the total revenue curve, the maximum of the total revenue curve is to the right of QP at QS. So if there was unconstrained sales maximizing, the managers might extend up to QS, which is way beyond QP. Okay. So under managers, the quantity sold will be higher, and consequently the price at which they sell it will be lower than under a regime of profit maximizing. But often the owners will impose a rule that there must be at least enough profit to generate a certain level of dividend. Okay, so it's got a profits constraint, and on your diagram in front of you that is shown as PR. Okay, and in that case the output that you would get is constrained sales revenue maximizing and will be at QS prime, which is slightly to the left of QS, but obviously where it is depends on how high or low the profits constraint is set. Okay, I think that just repeats what I've just done, but you might want to take a time just to read it through, exactly what I've said previously. So I'll go on to the next slide. Okay, there are various models about what happens when managers and owners are separated. There's the separation of ownership and control. We looked at sales revenue maximizing. Another good theory is one based on growth maximization. So in this case, there is a similarity of goals between the managers and the shareholders. Both firms want to grow for different reasons. The managers want the firm to grow because they have more control over what they're doing, they'll be more powerful, and again, this prestige thing that they might attract bigger and better firms. The shareholders want the firm to grow because a growing firm generally attracts a higher share value, so they also might make a capital gain on the shares that they bought for a lower price against the new higher price. The next concept mentioned on this page is something called the retention ratio. The retention ratio is important. When a firm earns profits, there's two major things that it can do with it, besides paying taxes, of course. One is to distribute the money to the shareholders, which obviously they want because they've got an investment and want a return on their investment. But the other thing that could be done, and very needed in firm, very sensible, is to reinvest some of that money. It's like company savings that you can reinvest to make the firm grow into a bigger and hopefully better firm, and through time more profitable firm. Okay, so if more profit is retained by managers, then it could be used for future investment. But if the retention ratio gets too high, shareholders will be not so happy because their earnings from the firm will be less. If shareholders aren't happy, then shares will go down in price, and managers won't like that either because there'll be a chance of takeover. So there's some compromise between the two things. Okay, this is quite a complex model, and we're just mentioning what could happen in these slides. The next one we're going to look at comes from Herbert Simon in the 1950s, and that is, it's very hard to know whether you've achieved goals. You can set goals, but have you maximized them? Have you achieved them? It's very hard. So what Simon suggested was something called non-maximizing goal, that you want enough that you know you're doing well, but you're not trying to squeeze everything out because you don't know where you'd reach the extent of what you can do and when you'd go beyond it. Okay, so this is known as satisfying. It's sort of like setting a satisfactory level of performance for managers rather than a maximum level that they must achieve. So you set initial objectives. If they're met easily, set higher ones. If they're too complicated and difficult to meet, set lower ones next time. That's the idea of satisficing. Okay, and then this flow diagram just shows you exactly what I've said, and I'm sure you can read through it for yourselves. Okay, I think I explained this when I did sales revenue maximizing, so I won't explain it anymore. The other thing is that when you have, what we're going to talk about is, if we think about a firm, we could also think of the sociological aspects of it, that a firm is made up of coalitions of different managers. And so it's not just shareholders with one intention, managers with another set of intentions, because within the management we might have different groups of people which where their achievements against their objectives will conflict. We can't satisfy everybody. So in this case, management has to set goals which resolve the conflict between, now we use this language stakeholder. Stakeholder is all the people that are involved in a firm. You are a stakeholder in a way in Tesco's or Asda, where you do your shopping, as well as the people that own the sorry, my voice is going. Excuse me. Besides the people who own and the people that do the day-to-day running of the firm. So again, when you're reading through the textbooks, I'm just trying to give a little bit of explanation to just think about it, that different groups within the firm don't always agree.